Check this out. Just over a year ago, the SORA rates were hovering above 3%. Today, it has fallen to below 1%. This sharp decline has triggered a wave of homeowners switching from HDB loans to bank loans. At OCBC, the number of homeowners switching from HDB loans to bank loans grew 7 times in the first 11 months of 2025. At DBS, the take-up rate for HDB loan refinancings in October and November has jumped 13 times as compared to the start of the year. But at the same time, another trend is emerging. Government bond yields have started moving back up again. The Singapore 6 months bond yield has risen from about 1.3% in November to 1.46% today. The 2-year bond yield has climbed even more sharply, from around 1.2% to about 1.48%. Even longer-term bond yields are ticking higher. So what does this mean for homeowners today? Where will mortgage interest rates go from here? Should you rush to switch to a bank loans before interest rates climb further? And more importantly, is it actually a good idea to refinance from an HDB loan to a bank loan in the first place? Let's find out in this video. So right now, bank mortgages have become extremely competitive. While the HDB loan rate remains fixed at 2.6%, some bank loan packages have fallen to as low as 1.35%. That difference of more than 1 percentage point may look small on paper, but in dollar terms, the savings can actually be quite huge. Take for example, if you are switching from a 2.6% HDB loan to a 1.35% bank loan and you have an outstanding loan of about $300,000 on a typical 3-room HDB flat, you will save roughly $180 in interest every month. That works out to more than $2,000 of savings a year. Then as the loan size increases, the savings will grow quickly. On a $400,000 loan, the monthly savings rise to around $240. On a $700,000 one-bedroom condo loan, the interest savings increase to $425 a month. And for a larger $2 million 4-bedroom condo loan, the difference can even go up to $1,200 every single month. For many households, these are definitely not small numbers. A few $100 less in monthly repayments can significantly improve cash flow, whether that money goes towards daily expenses, investments, or simply building up a buffer. That's why refinancing looks so attractive right now, especially for homeowners who have a large outstanding loan and long remaining tenures. Speaking of refinancing, one thing that can really save you a lot of time and headache is using a mortgage broker to find the best rates. And one of them is Cashew.sg. So instead of having to manually dig through different bank websites or spending hours calling hotlines just to ask for rates, with just a few inputs, Cashew helps you compare the best loan packages across multiple banks, all in one place. And the best part, this service is completely free. There are no hidden charges or fees involved because Cashew earns its commissions from the banks and not from you. So you get all the benefits without having to pay a single cent. And if you ever have questions, you can use their AI chatbot to check for loan rates, understand the fine print, or even just get a bit of refinancing advice. It's like having a friendly mortgage consultant on standby 24/7 without all the awkward sales pressure. So if you want to save on your mortgage loan, check out Cashew.sg using my link down below to see how much you can save today. But then, while the current rates look very compelling, the question is, will mortgage interest rates stay low, or are they already showing signs of turning? Looking back at 2025, mortgage rates in Singapore have fallen sharply as global funding costs ease. At the start of the year, fixed rate home loans were still hovering around 3%, but after several rate cuts by the Federal Reserve, SORA declined all the way to below 1% by November. This pushed both floating and fixed mortgage rates to their lowest levels in 3 years. However, when we look ahead to 2026 and beyond, the outlook becomes far less certain. According to the Federal Reserve's summary of economic projections, inflation is expected to continue trending down, but only gradually. Policymakers are no longer signaling aggressive rate cuts. Instead, the Fed's latest guidance suggests that the era of preemptive easing is largely over, and that any future rate cuts, if at all, are likely to be modest and highly data-dependent. At the same time, there's also growing caution within the Fed itself. Reporting from CNBC highlights that several officials have expressed concern that easing monetary policy has gone far enough, and any further rate cuts could threaten to reignite inflation. Meanwhile, some policymakers believe that interest rates may already be close to a neutral level, and that any further changes should depend heavily on how the economy evolves. Because of this, many mortgage analysts now believe that most of the rate adjustments has already happened, After the sharp decline in 2025, any further large drops in mortgage interest rates are becoming less likely. And there's also a growing view that SORA may have already found a floor, unless there's an extraordinary economic shock, such as a deep labour market slump or a sudden recession. So, while mortgage rates are expected to stay low for now, the big easy savings may already be behind us. At this point, the decision is more of whether you want to refinance to lock in the savings today or accept the risk that rates could move sideways or even slowly creep back up in the years ahead. Which brings us to the question of, should you switch from an HDB loan to a bank loan to save on interest rates? Here are the things that you should seriously consider before switching over. The first and most important point is that the switch is irreversible. Once you refinance out of an HDB loan, you can no longer go back to it. So, while you may enjoy the lower interest rates today by switching out, if ever the rates go back up in the future, you will be stuck with the higher bank loan rates. Second, HDB loans are far more flexible, especially during difficult periods. For example, under the HDB loan scheme, homeowners can apply for a temporary reduction or deferment of your monthly installments for up to a year. In certain situations, mortgage interest can even be suspended for a year under schemes such as the Homeowner Job Support Program. Besides that, homeowners can also extend their loan tenure up to a maximum repayment period to lower monthly installments. So in that sense, HDB is actually quite chill. Bank loans, on the other hand, do not offer the same level of flexibility. Most bank loans come with a lock-in period of 2 to 3 years. During this period, if you want to refinance, repay the loan early, or sell your property, you will typically face a penalty of around 1 to 1.5% of your outstanding loan amount. And these penalties can be substantial, especially for larger loans. Then, once the lock-in period ends, the interest will usually go up. At that point, you either have to accept the higher rates or go through the repricing or refinancing process again, while incurring fees each time. For example, when you refinance to another bank, legal and valuation fees can typically cost around $2,000 to $3,000. And while banks can often waive these fees for loan amounts above $200,000 to $250,000, smaller loans usually don't qualify for this fee waiver, meaning homeowners may need to pay out of pocket. Then there's also a difference in how repayment difficulties are handled. If you run into trouble servicing an HDB loan, HDB will generally work with homeowners to restructure repayments. Banks, on the other hand, operate strictly based on contractual terms. So when you miss a payment, you may incur late fees as well as additional interest charges. And if the situation continues, the banks may take legal action, and that could eventually lead to a foreclosure. Though, some banks do offer short-term relief measures, such as temporary installment deferments. But these are usually limited, and interest will still continue to accrue. And finally, there's the psychological factor. On one hand, HDB loans offer certainty. Their rates have stayed at 2.6% for decades, so you know exactly what your interest rates will be, regardless of what happens in the global economy. On the other hand, bank loans come with uncertainty. Interest rates can change all the time. For homeowners with stable income and strong cash buffer, this may not be an issue. But for those with a variable income or tight cash flow, that uncertainty can become a real source of stress. In short, mortgage rates are low today, and bank loans are looking very attractive. But before you switch from an HDB loan to a bank loan, you need to first be comfortable with giving up the flexibility and certainty of the HDB loan for good, and whether your finances can handle higher repayments if ever interest rates rise in the future. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe, as I'll be posting new videos every week.